I'm here with Tom Williams, a former professional syndicate trader and inventor of volume spread analysis and trade guider. So Tom, you were a former professional syndicate trader based in Beverly Hills in California. You returned to the United Kingdom when you were 40, you'd made your money and you decided to really experiment with computers to develop volume spread analysis. But my question to you is, can you just give us a brief overview of how you became a syndicate trader and your experience from the day you arrived in Beverly Hills? How did you get involved with that and what led you down the path to actually developing VSA?
Right, well, when I first went to the United States, don't forget, I was only in my late 20s. In those days, not many people had money, but I had enough to live on, obviously. But I was qualified in England as an SRN, that's a state-registered male nurse. And of course, as soon as I got to Beverly Hills, I realized that I could make a nice salary by becoming a California RN, which they gave me fairly promptly. Then you work through an agency and you get sent out on these various jobs that require my services. I'm not the sort of person that really enjoyed rushing around a hospital in green attire with a stethoscope hanging around my neck, all this type of thing. Not really my scene. But I certainly enjoyed being sent out on these various jobs by these agencies. But the agency rang me up one day and said, look, we've got a guy who's trading the stock market with millions. He's doing it. But the big problem is the family is very worried because he's trading all this amount of money and he's a drug addict. So what they want somebody like me to go along and be a minder. That's medically speaking, of course. And sure enough, that was the job. And this individual was, I found out, part of this trading syndicate. Matter of fact, he was the boss there. And he seemed to like British people, fair enough, and I got on very well with him. And he suddenly asked me to draw some charts for him because a drug addict, their hand is shaking, you know, they're not very good at that. But I was quite good at technical drawing. So I got a roll ruler, got long charts, which they supplied. There was girls there, or women, taking the information from the ticker tape, which is like a large glass jar turned upside down, and the ticker tape would be ticking out with all the information we needed to draw a daily chart. Of course, this was before computers, so all we really had to work with was end-of-day charts. And that's why I think you'll see when I'm analysing the market, I love to look at a daily chart, end of day, because there's a lot of information in there for you. And that's how I got started. Of course, these guys in these agencies, they're too busy to actually sit down and teach you like we're teaching you. They don't do that. But so it took me 2 years to get to know more or less what they were doing, what they were up to. Mm-hmm. And of course, the owner of the syndicate used to tell me, you know, give me all this information, fair enough. But they said, oh, look, you need to take the Wyckoff course, get some idea what it's all about. So they paid for it. It was $500 a course, and it came in 2 or 3 black edge sort of books or folders, you call it. Mm-hmm. But all the charts were pre-war, and it certainly helped me get me going. But that's how I got into understanding the market as such.
Explain to me, what is the connection between a trader in the early 1900s called Richard DeMille Wyckoff and you today, Tom Williams, the inventor of VSA, and how have you further developed and embellished the work that Richard D. Wyckoff wrote about all those many years ago?
Well, of course, it was computers. Wyckoff would have loved a computer. A computer allows us to draw any time frame we more or less want to see, minute charts, 9 minutes, 18 minutes, whatever you want, and a host of other things it does for you very, very quickly. And of course, in Wyckoff's day, that wasn't available. All he had was, the only thing he could do was to read the ticker tape, which is more or less like we do when we're running a 1 minute chart on a computer automatic system. That's really ticker tape reading, which is interesting. You can actually see all the supply and demand coming in. That's all he was looking at. And but that was the main thing. And then when you sit down and you get a programmer that's capable of putting in your ideas into a computer, then you've got to sit down and logically explain to the computer the logic that's in your head and what you're thinking about. No formulas are used. All it is based on supply and demand, knowing that definitely is the driving force of the market. And then you have to spell out, the programmer then codes it in, and then of course you've got to test it. But that's where my knowledge really started to race forward, because I have to be right. Computers don't understand flaws in your thinking, flaws in your logic. There's no good about that. The computer it just does what you told it to do. And if you see the signals appearing, say even on a 1 minute, and they're uncannily accurate, then you must have the logic right. Okay. Otherwise it just wouldn't work.
Would it be fair to say that you have computerized and possibly simplified the work of Richard D. Wyckoff and put it into a computer program that we now call Trade Guider?
Well, I would say definitely yes. I would definitely, without question. I mean, I've had people ring me up and they say, look, I remember one individual I sold my book to, and he called me up. He said, you know what, I've taken all these courses, I've looked at all this, but I read your book overnight, and that made it far more clear than all the previous work that I put into studying Wyckoff. It's very, very tricky. I find it easy. Now, why it's tricky, you need somebody else to explain that. Why understanding supply and demand is tricky. And what they don't understand is that the market, without question, works on supply and demand from the activity of the professional side of the market. And you can see them coming in, for example, on the lows. If you see a down bar after a decline on a narrow spread, and the volume is ultra high and it closes in the middle, especially if it's on the lower trend line, you can draw trend lines on there. There has to be professional buying that's come in. Nothing else can do that, really. But that's the type of thing that confuses people, is that's why strength always appears on down bars, because the professional money has to take the opportunity to get in on low prices without their huge buying putting the price up against their own buying. There are no friends in the stock market, and the market makers and specialists can see these large groups coming in, and they will do their best to do them out of a trade.
Okay, Tom, do you believe that the financial markets are manipulated by the smart money? And if so, can you give us some of your thoughts and experiences of when you were a former syndicate trader and sort of tricks that maybe your syndicate got up to?
Well, the thing is, you see, if you're a professional trader, you've got to do your utmost to buy on low, depressed prices. And the best way to do that is to create bad news, put out rumours, do whatever you can, seize the opportunity of some serious news coming in, and then the market's markdown hopefully shakes people out of that. There was one example that we used to get up to all sorts of so-called tricks. I mean, we used to trade Teledyne, and Teledyne, the actual company, used to have an annual general meeting in Beverly Hills, and we used to plant people in there. In the meeting, there'd be quite a large room with perhaps several hundred people in there, and all the directors would be sitting up on the stage, you know, behind the table looking out at you. But we'd have planted questions to rather encourage people either to buy or encourage people to sell. we'd be asking awkward questions, like we might stand up and say, is this correct? We've heard secretly that you've got a huge order from Saudi Arabia for your products. And of course, it was a complete fabrication. Then the directors would look at each other and sort of shrug their shoulders. But the audience heard that, and they think, aye, they've got something going on, they're keeping it secret. And that would definitely have a nice big surge of buying next day. If you were distributing, we'd say, sure, we'll let you have it all, because we've bought in the lows, we're now encouraging people to come in and buy it off us. That goes on all the time, that type of thing. If the opportunity's there, a professional trader will take it.
Tom, in both of your books, you refer to the herd and you refer to the news and how the news drives the herd. I want to talk about a specific example. Last year, just after Lehman Brothers had collapsed, the stock Goldman Sachs fell very heavily on high volume, and yet the next day there was an up bar after it. In a seminar in November that we did live together, you actually said, if that isn't a buy signal, I'll eat my hat. And in January, we did a seminar together, the end of January. You saw what looked like a test, and you again repeated that this market was, or this stock was highly likely to move up. Where is the best place to buy any instrument after you've seen climatic action on a down bar?
Well, of course, don't forget, you've got the liquidity problem. When you get Goldman Sachs, you've got a very, very liquid company there with lots of stock out there. And for that stock to actually become bullish, you've got to shake out all the potential losers that are in there hanging on, hoping for higher prices. And sometimes it takes quite a bit of effort to mark that down and shake people out. It will eventually happen. And the market cannot become bullish until most of those people are in fact shaken out.
Tom, so these shakeouts happen on very bad news. The herd, as you call them, will be in fear, petrified, probably selling their holdings, which is what a shakeout is designed to do. But as we've seen in this great credit crunch where the banking sector was told was very weak, it was going to fall, it was going to keep collapsing, and yet in January it began to rally and it's now up some nearly 300-400%. At what point should a VSA trader begin to look for buying opportunities, and perhaps you can tell us what sort of things they need to be looking for?
The most important thing, of course, is strength in the background. You must be aware of what's happened in the background. And when you see these climatic type bars, in other words, very high volume on a down bar, especially if they're on narrow spreads, and especially if the news is very, very bad, then that's professional money moving in. You must be aware that's in the background. Now that won't disappear, that'll stay there. And as the market then, if it's a very liquid market, it usually will churn, and eventually you will start seeing a test. In other words, a bar that's back down into that area where you first saw the high volume, and you see that the volume is considerably less than that very high volume we originally saw. Usually they're on narrow spreads, close in the middle, and that is a sign that most of the selling has disappeared, and that's what the professional money has to have. Because it can't create a bull move in a stock that they're handling with potential sellers still in there. Because every time they mark it up, there's people annoyingly selling into your up move. You've got to shake them out. And the way human beings are, the way the herd works, they will get shaken out. And that stock won't become bullish until, in fact, you have shaken them out. It's as simple as that. I thought we would accumulate one stock for 7 years. But then other times, when you get catastrophes like 9/11, it only takes a couple of weeks to shake everybody out, or a week or so. So it's in intensity too. But you have to be flexible in your thinking. But if you understand the underlying principles, then you can't help but see that eventually.
I've heard from a number of traders and investors that have read both your books, The Undeclared Secrets That Drive the Stock Market and Master the Markets, that when they read those books for the first time, it's almost like a light bulb goes off. They say to themselves, well, why didn't I get given this information 5, 10, 15 years ago when I started to trade? Why is it I've been using all these mathematical formulas to try to find trades and find that I'm losing money? And then they start to explore volume spread analysis, but in the first few weeks and months, it seems it's almost a barrier. And many people tell me that after they go past that barrier and become very profitable, they see the light, so to speak, because they've almost had to unlearn some of the bad habits that they've got into. What do you think about that? Do you feel that that's partly the reason that VSA takes longer to learn because of the bad habits people have learned in the past?
Don't forget that practically all the people that are interested in the stock market are basically highly intelligent people. They're people that are successful in life. They're usually people that say, thank you very much, I've got a nice job, I've got a nice house, I've got a nice car, I can go to nice restaurants, thank you very much. But so what? I'd like to earn a little bit more money, and perhaps I could stop working quite so hard on my present job and do a bit of trading. It sounds good. Now, logically, that sounds very good. But the problem is that you being a human being, you will be reading, listening, watching TV, very keen, thinking that is the way forward to help you. You'll be listening to brokers, you'll be picking all this information up. Now that information will be churned around in your mind, and by the end of the day you will have formed a gut feeling about that market. But that gut feeling will be wrong. And the reason it will be wrong, you can't trust yourself in the market. The reason it be wrong because they're not telling you the full truth. I've never ever heard the full truth being told on television or ever read it at all. They don't tell you that the professional money moves into the market on all this bad news and rapid down moves perhaps, and everybody's all doom and gloom. Like the last lows, there was a meltdown everywhere, the banks were going bankrupt and so on and so on. But what they don't tell you is that if the commentators knew what they were talking about, they'd say, this is true, but don't worry, because we've got very accurate information from our people on the floor of the exchange that all the dealers are frantically buying everything they can. That means that this is going to make it a strong market. It has to, if all the dealers are rapidly buying, rather than a weak market that all this news and doom is inferring. And they never tell you that. I've never heard it. And that's why it's so confusing. Because if you come into the market and you're using your past skills that you've been very successful with all your life, if you want to buy a house, you jump in your car, you run by the house first and see whether the area suits you and the whole thing looks okay. And then if you like that, then you view the house, and if you still like that after viewing it, then you get a surveyor in, and if his report is good, then you say, right, I'm going to buy. But you can't do in the stock market. They don't give you that type of information. And that's why very highly intelligent people, doctors, surgeons, very often find it difficult to understand that. But you've got to understand it's driven by professional money. That volume you see at the bottom, at least 80% of that volume is activity of the professional side of the market. That's what drives it. And that's why we call it volume spread analysis. On that volume or on that activity, what did the market actually do? That's the key to it. And that's why people have difficulty in understanding what on earth is going on. See, I've heard highly intelligent people, even professors and people, say, it's impossible. You can't tell me if the market's going down tomorrow or up. It's just nobody in the world can do that. The markets are chaotic. They work in a chaotic sort of fashion. You can't tell me that. Nobody knows that. And that's what they think. And that, if somebody coming into the market trying to understand it and they hear that, they will more believe that than believe us when we tell you we can't tell. And that's why people have difficulty.
Tom, you've referred a lot in this interview to the stock market, and yet the VSA signals and trade guider work in all markets and in all time frames. Now this is a confusion for many. So how is it, Tom, that the signals will appear on a daily chart of maybe one of the indexes or a stock, but you can also see the very same signal on a 1 minute chart in Forex? That just can't be, Tom, can it? Perhaps you can explain.
Right, well, that's a difficult question, but believe me, it does work. And I call it stock market because I was trained in the stock market, and it's such a habit to call it the stock market or stocks. But anything traded by human beings, the way they do, will work on supply and demand. Each of these vehicles that you're trading, you may be trading the pound, you may be trading sugar, you may be trading the mini S&P. They will tend to have their own personality, that's why professional traders really like to specialize in certain areas, so they really get to know and understand how that vehicle they're trading behaves, how it behaves.
Okay, Tom, let's just imagine, just for this moment, that every trader and investor in the world has a copy of Trade Guider, copy of your book, and is using the new VSA signals that you've developed. Now, we're only imagining here. Would that have an effect on the market? Would all the markets just go flat, or would everybody be winning? Which, of course, I don't think they would. But what is your view on that? We get this question asked all the time. What's your view?
Well, I mean, that'll never happen because the markets are so liquid. As we call it, the stock market is the largest business in the world, well, second to currency trading. And you're dealing with the actual human beings. You get some people like to scalp 1 minute charts, you get others that like to trade daily charts on the stocks, even weekly charts. If you're a fund manager, you might be more interested in that. But I can almost guarantee that if you put 10 people in front of the same computers, the same information, they'd all trade differently, because you're a human being, and that's what makes human beings, is you will do different things with different information. You might all be correct, but you'll trade it differently. That's almost for certain. And the markets are so liquid, there's so much volume going on there, that I doubt very, very much if everybody in the world was using VSA, it would make a great deal. It might smooth the market out slightly, but not a lot.
What would be your favourite setup using volume spread analysis to take a trade to the long side?
My favourite setup would be to see a sign of strength appearing, right, which would be usually stopping volume. You get a ultra high volume down bar. It's probably bouncing off the lower trend line. If you're lucky, the spread will be narrow, but even if it's wide, it'll probably close in the middle. But the volume is ultra high, so you know the professional money must have stepped into the market at that time and said, right, we're going to buy all this panic selling, because it would have probably gone down there on bad news, and it's the way the herd works. They will all seem to do something in a very similar time, and under the same pressure, the herd will. As these markets fall, comes a time when the news is very, very bad, it plummets down, and they say, oh, I'm fed up with this, I'm getting out of this. And they tend to dump their holdings onto the market. Professional money says, thank you very much for letting me have this at such a lovely low price. And they buy into the market. You can see that happening. Now, okay, I suppose you could buy that, but normally what happens is, especially if the market is a liquid market, it may go up 1 or 2 bars, and you may see a bit of no demand, because the professional money doesn't want that stock or vehicle to go up at that time. They need it to float sideways and down to accumulate more. But if you know that's going to happen, or looking for those setups, and then you see the bar at some time in the future, maybe 10 bars later or what, we can't stick a time to it, because then you'd be using a mathematical formula, which we don't use. You see a down bar back into that area where you first saw that high volume down bar, and it's usually on a narrow spread, but it's got to be back into that area. If it's a narrow spread, close the middle, and you look at the volume, it's considerably less than that volume that you originally saw, then it means that the supply has been dried up, absorbed, and that's the best setup to go long on.
Several times during this interview, you've been quite insistent that we, Trade Guider, do not use mathematical formulas to produce the signals. And yet, they say 90% of retail traders, the public, are losing money in their trading, and many, if not most of those traders will be using backtesting, optimization, mathematical formulas to try to find certainty in the markets, Tom. Why is it then that we don't use mathematical formulas and we actually look at supply and demand and volume as our key to the activity of the smart money?
We don't use mathematical formulas because the market does not like to be told, right, now's the time you're supposed to go up, or now's the time you're supposed to go down, because you've done that in the past. Now, without any scientific study on this, I personally would think that when you go back in hindsight and look at these formulas, yes, they were written by clever people, and in the past they may look quite good. But I've got a feeling that they only look good because they were not traded sufficiently. If you had a certain guaranteed formula that really worked, the professional money would soon find out about it. They'd jump on it. And the very fact is they were on it, it wouldn't work, wouldn't be there in the first place. It would be traded out of existence. And I've got a feeling that's what's going on. You can't beat understanding the market moves on supply and demand, and you can see it unrolling in front of you as a chart. I mean, even if you miss these and you look back in hindsight, you say, well, look, there's a buy signal there. Now, you may have been looking at the market at the time, you just didn't see it. But that's not the program's fault. There's some other reason. If it was there in hindsight, it must have been there in the leading edge of the market.
Now, one of the things that we talk about when we talk about VSA, when we're having our discussions, is the word intensity, and the intensity of a move up or down. Can you try and clarify for us what you mean by intensity of a move?
Well, for example, you might see a bullish move up, rally up. The bars may have shot up for 4, 5 or so bars, and suddenly you get a gapped up bar on a narrow spread. They gapped it up deliberately beyond some sort of good news. The volume is ultra high, right, and it probably, well, it can more or less close anywhere on those, but it's gapped up. And that's a signal we call end of a rising market. Now, I've seen that on a currency, the pound, for example, something similar to that, marking the top of the market. And the very next bar goes up on no demand. So that intensity there, you see, is the very next bars confirming, yes, this is weakness. It's been marked up deliberately, and the volume is low, showing the professional money is not slightly interested in the upside of the market. So that's intensity. When another chart you may be looking at, the low volume up bar on no demand may not appear for 10 or even 15 bars or so.
Tom, what is your favourite trade setup if you're looking to take a short position in the market?
Right, my favourite setup is more or less what I've just told you. You wait till you see an up bar on ultra high volume after, I must keep saying after you've seen an up move. Right, it may throw a signal up, they usually do. The market then may come down a couple of bars or so and drift sideways. But what we're looking for is now an up move back into that area or level where you first saw the high volume. If you're lucky, the spread will be narrow, it'll close in the middle, and the volume will be clearly less than the previous 2 bars. That's a perfect place to short. Very, very low risk area to short the market on. It's virtually impossible for that market to go up after that.
We at Trade Guider don't give buy and sell signals. However, we do say that these signals are uncannily accurate. When the market is in an uptrend, as designated by the green diamonds, and in my particular version of the software, blue bars, but that's customizable, and we're clearly trending up, and a red signal appears in Trade Guider, I often find that's not the place to sell the market, it's just the market pausing. What would you advise people to do if they see a red signal, but clearly there is an uptrend behind you and there's strength in the background?
Well, don't forget, if a red signal appears, if it's genuine, right, you will have some sort of weakness in the background. But very often the market may be so bullish it'll start rallying up, and in 1 bar it'll suddenly want to rest. It'll fall back on the low and rest. That looks like it's not an up thrust, but it looks like an up thrust, but it's not, because you've got immediate strength behind you, not weakness. And the dialog boxes will say potential sign of weakness. If the next bar is up, ignore the signal or proceed with great caution.
Okay, Tom, let's take the opposite then of the uptrend and look at the downtrend. Let's say the market is declining, we're making lower highs, we have red diamonds, in this case with my software we have red bars, so we're clearly down, suddenly a green signal appears on the Trade Guider software. What would your advice be in that situation?
Well, the markets often test, but if you've got serious signs of weakness in the background, that test is usually what we call a fail test. The market may look as if it's tested, the volume may even be low, but if you don't get a response from that and the market drifts sideways or even comes off slightly, then that's what we call a fail test. Because if that test was genuine, the professional side of the market and the market makers and specialists would spot that straight away. They'd be in on that going long. But if they refuse to do that, then they must be bearish. They must know something we don't know. So we call that a fail test, and you see that quite often.
Tom, you mentioned the test. The test is testing something. It seems to be one of the more confusing parts of volume spread analysis. We have tests on down bars, but is it possible, Tom, that we can actually have a test on an up bar?
You often see tests on up bars. In reality, the computer comes up with a signal and test. But if the test has been an up bar, what you will find is that you've got what we call a bottom tail. In other words, quite a lot of the bar is sticking way down. So it means that in a lower time frame, there was a test there. And because the professional money are watching that and they're bullish, they see that and they start allowing the prices to go up. And that's why by the time you reach it with your longer time frame, right, it looks as if it's up. But all genuine tests always appear on down bars, or certainly level bars, but down bars usually, because that's what they're doing. They're testing the amount of supply present. But that might happen on a 5-minute chart or 10-minute chart. But if you're looking at an hourly chart or 30-minute or something, then sure, because the professional money saw the test was a good one, the market then rapidly starts going up or moving up, and it will look as if it's on an up bar. But if it's got a down tail to it, you can be reassured it was a test on a down bar.
Okay, Tom, can you just clarify for me what you mean by the tail of the bar? I'm assuming you mean the bottom, the very base of the bar where the price started. And I would also make the assumption that the volume would have to be low, as that would be what a test looks like. Is that correct?
Well, the volume would be low because the main body of the bar has plummeted down. You can see it. It's plummeted down on the shorter time frame. Right, there was no selling pressure, therefore the volume's low. It closes very often on the high. Professional money see that and allow the market to drift up or go up. after that. By the time you get to it on your longer time frame, might even be a daily chart or an hour, or who knows. You have to look at that. It would appear on up bar as far as you're concerned. But if you look at a shorter time frame, it would be on a down bar, the initial test.
Okay, this really does solidify what we've been discussing earlier about multiple time frames, which is so important to the trader, and what you've mentioned there about identifying a test on the smaller time frame and on the larger time frame it might look slightly different, makes a great deal of sense. And of course, in a bull market, we will be looking for that type of test at the bottom of the uptrend channel to get our best position to the long side.
Well, the beauty of computerization is you can flick around these charts fairly quickly, and you can put up a 5 minute, 1 minute, 10 minutes fairly quickly. And that's why you really need to specialize in certain areas if you want to trade successfully, so you're not rushing around trying to find something you may have missed. So it's quite simple. I mean, I used to, when I was actively trading, I'd have 4 or 6 charts up in boxes on the same screen, and I could flick on any one. It'd be the same chart but different time frames, and I could watch the whole scenario unfolding in front of me. And I could click on any one of those boxes, throw the chart up large, and I could follow it.
It's every trader's and investor's dream to find what they would consider to be the holy grail of trading, an automated trading system that takes away the need for human intervention and greed and fear. I'm aware that you've been working on such a project that you called affectionately the Holy Grail for the reasons we've discussed. But most importantly, does this Holy Grail exist? And in your view, are we likely to see something along those lines, an automated trading system using VSA signals? And are you working on that?
Well, yes, we are. We've been working on it for some time, and it looked very, very promising. It's a tricky one because the market's so variable, but we will, don't be surprised if we come up with one. It may take a year or so to come up, but what we're going to do with it, if it's all that successful, well, we certainly let the VSA club members be the first to see it and use it and look at it and test it. There's no question about that. And of course, the VSA club really is the core platform for TradeGuider, and all the information, as much as we can possibly muster, will be in there. And any new systems will certainly be there available to the members.
You mentioned there the VSA Club, Tom. Can you tell us a little bit more about the VSA Club, why it was invented, why you are very active in the club, maybe what your expectations for the club are in the future, and why you believe it's important that people should be a member of the VSA Club, of which, of course, you are in charge?
Well, of course, the main purpose is to have a central point where people can tune into, and they don't sit there all alone. Most traders are isolated. Either they buy some software and they've got to figure it all out for themselves. There's no training with it. Once you've bought the software, the people that sell to you are not really all that interested in you. But we don't work like that. We take great enjoyment of actually teaching you as much as we can about the software and how the market works. And of course, the VSA Club is an ideal spot to platform that for you. And we try to, I personally, I do a recording, usually Friday afternoon at 2:30. I like to watch the S&P, mini S&P open up and see if there's any setups that we could trade on, which is very interesting. It's a good market to trade, there's no question about that, because it's professionally driven. There's so many opportunities in there. You can definitely trade the mini S&P. Now, Saturdays, I try to get, with the help of Peter Offen, a newsletter out. Now, what I call a newsletter is just looking at various indexes. Perhaps it would definitely be the S&P 500. It might be the NASDAQ as well. It might be the pound. We should really talk more about the indexes in the Far East. See, there's a lot of interest there. the Hong Kong index and so on, and mark the chart. Like I might say point A, here you can clearly see there's a test. So you can look at all these things in writing and then mark clearly on the chart. And if you keep studying those, then surely you'll get to know what I know. You have to.
Tom, several weeks ago, a news report was released about a software system developed by Goldman Sachs that was capable of manipulating the financial markets. Do you believe that such a software system exists, either held by Goldman Sachs or others, and do you believe that it's capable of being able to move a market?
Right, well, if that was true, which I must say is highly unlikely when they use the word manipulate the market, because the market's massive. And if there was anything there, any secrets, professional money would be onto it like a shot, believe me. And you've got so many intelligent people there. But if there is manipulation, but it's only on things like the news and marking the market up or down artificially on news and that type of thing. But that's what VSA is all about. We can spot all that going on, and we know what the supply and demand situation is by looking at the volume, looking at the price spread and what the market's done, and we know what's going on.
Tom, someone has just purchased the Trade Guider program, the Getting Started course, your books, and all the accompanying videos. It's a lot of information. We want to get them on track to being profitable as quickly and efficiently as possible. What would be your advice to that trader or investor listening to this video, and where would you point them initially to look for information to set them on their journey to become a VSA expert, most importantly, a profitable and consistently profitable trader?
Well, what I would say is you must read the book, either or both the books that I've written that are available from Trade Guider carefully, so that you've got a good idea, the overall concept of it. And then you study the rules, study the dialog boxes, and you don't do anything until you're fully aware of the principles involved here. You can make money, there's no question about that, but the big thing is with VSA, it gives you low risk entry points and low risk entry points to the short side of the market, and that's a huge advantage to you as a potential trader. But don't rush in just buying and selling without knowing more or less what you're doing, because the markets is a very, very dangerous place to be. The whole market works in such a way, it's there to confuse you, it's there to mislead you, it doesn't exactly lie to you, but it never tells you the truth. Mm-hmm. And so you've got to be very, very cautious.